Hi, I'm Jonathan. In this video, I'm going to be talking about transferring property into an SPV limited company. Now, I'm going to break the video into 5 parts. So 1, what's the process? 2, mortgages. 3, deposit requirements. 4, is it worth it? And 5, a bonus at the end. So stay tuned for that. So let's start with the process. So let me set an example. You own a residential property and you're looking to move out of that residential property and buy a bigger one. Now, the existing property is in your personal name, and what you're thinking about doing is moving that into an SPV limited company whilst also buying the new property. So if you think about it, the existing property, you are both the buyer as well as the seller. So from a legal perspective, you'll need a solicitor acting for you on the sell side. You can choose any firm you like. On the buy side, you'll have to work with a legal firm that's approved to the limited company mortgage lender. So just a pro tip here, most lenders, in fact, all lenders, have approved lists of solicitor firms that they can work with. Just choose one off the list and then you'll only pay one fee and work with one firm. The alternative is obviously you can pick your own firm, but you'll have to pay 2 sets of legal fees, one for the lender and one for you, and it's 3 times the headaches, trust me. Okay, so that covers the legal side of things. Let's talk about stamp duty. So on the new purchase, so the one that you're moving to, you won't pay the additional rate of stamp duty on that. But the purchase of your existing property via your SPV limited company, you will be paying the additional rate of stamp duty on that. Now, depending on what the value of your current property is and what the value of the new property is, in fact, you could actually save money in stamp duty. And there's been a lot of occasions where a lot of clients have actually looked at it and said, well, actually, it kind of makes sense me moving the existing property into an SPV because the total amount of stamp duty is less than if I kept that property in my personal name. Now, of course, if you did keep the property in your personal name and you bought the new one and obviously paid the high rate of stamp duty on the newer property, if you were to sell your old property within 3 years, you'll get that stamp duty back. Okay, so that concludes the process. So in summary, you are both the buyer as well as the seller. If you're looking to transfer your residential property into an SPV, there's no capital gains tax, but you will be paying the higher rate of stamp duty on that purchase. If it's an existing buy-to-let, then obviously check with a tax consultant or accountant that there's no CGT, in other words, capital gains tax liability. Mortgages. So let's start with the same example that we did before. So you've got a residential property, you're looking to sell that residential property to your SPV and then purchase a new one. So let's assume that on the residential property that you own, you currently have a mortgage with the likes of Santander, HSBC, Nationwide, whoever that may be, and you're locked into that fixed rate for a period of time. So to exit from that mortgage, you'll have to pay exit penalties. So there's a couple of things that we do here. There's a couple of things that you can do as well. So 1, most high street lenders will allow you to port the existing product to a new property. So effectively, you would port the existing balance to the new property and then top up that loan, if required, to the level that you need in order to make the transaction go through. So for example, let's just say that your existing property is £350,000 and you have £200,000 outstanding on the mortgage. The new property is £800,000 and you need a £500,000 mortgage. What you would do is transfer the £200,000 from your current residence to the new property and then top up with a new product on today's rates at £300,000. So effectively, you'll have 2 products running with the same lender. So that's how you can avoid early repayment charges. Now, on the limited company side, and this is really important, most limited companies, in fact, all limited companies will allow you to purchase your existing residential property. That's not a problem. But what you need to be really mindful of is the deposit requirements. So currently, and if I just take you back to that example that I mentioned, value of the property is 300, you've got £200,000 outstanding, or value is 350 and you've got 200,000 outstanding. You've got £150,000 equity within that property, and we'll just use that as an example. With some lenders, they would require you to gift that £150,000 to your SPV. Now, we never want to gift anything to a limited company. We always want to loan monies to a limited company. So we have to work with a lender that will be happy for you to note the deposit funds as a director's loan. So effectively, all we do is we move part of the deposit funds, typically around 25%, from your personal name into the limited company, and then we note that as a director's loan. It works on a very similar basis as if you had cash in your back pocket, you took the cash from your personal bank account, put it into the SPV bank account, and then use that as a deposit. But this time, because you already own the property, the equity is already built in there. So effectively, all we're doing is we're just transferring said equity from personal name into limited company or SPV company, and then noting that as a director's loan. Why is that important? It's important because at a later date, any retained profit that you have in your SPV, you can draw out as a director's loan without incurring any tax liability. Pro tip, do that. So let's have a quick recap. So we've got solicitors on both sides, buy side and sell side. We've got the SPV limited company mortgage offer in place. We've got your new residential porting and further advance application in place, ready to go. The next stage is to complete simultaneously. So one transaction completes at the same time as the other one. So here's a pro tip for you. Let's just say the value of your property is £350,000 and you've got a £50,000 mortgage. You need the equity within that property in order to purchase the new residential property and cover things like legal fees, stamp duty, acquisition costs, etc. What we can do, or what you can do, is increase the loan via the SPV limited company side to 75%. That will then release the equity from your existing property into your personal bank account, which can then be used as deposit funds and stamp duty, legal fees, mortgage broker fees, etc. on the new purchase. So essentially, you borrow more money on the limited company side. That releases the equity on the sell side because you're selling your property to your limited company. Those funds hit your personal bank account. In fact, they hit the solicitor's bank account, and that solicitor can then move it across to the other solicitor in order for the transaction to go through. Now, this gets a little bit more sophisticated, and it's designed for limited company directors who own limited companies that have retained profits within those businesses. So essentially, if you're watching this video and you are a business owner, you own a limited company that has retained profits, you can work this in a slightly different way than I explained previously. So let me explain. Let's just say you have a company in the background that has £350,000 cash sitting in it, retained profits, not doing anything, just sitting there. What you can do is an intercompany loan from your trading business into your SPV. The funds then sit there. Now, getting back to the previous example, you've got a property worth 350. We now have £350,000 sitting in the SPV bank account. You can use that £350,000 to buy the property for cash. Okay, so you buy it for cash. What that means is any mortgage payment or any mortgage balance which is left on that property will be repaid by the 350, and the rest of the money will then get paid into your personal bank account. So intercompany loan, 350 into SPV. SPV then purchases your existing property for 350,000. The 350 pays off the mortgage balance, whatever that may be, call it 50 grand. Then 300,000 will be diverted back into your personal bank account for you to then use as deposit fund stamp duty for your new property. It is a very, very tax efficient way of utilizing retained profits in a limited company. It's a bit more sophisticated, but great way to move forwards and utilize those funds in a very cost effective way. Right, quick recap. So we've covered off the process, we've covered off mortgages, we've covered off directors' loans and gifts and why you should do one and not the other. And I've thrown in a little bit of advice for our limited company owners who have trading businesses, have retained profits and intercompany loans. So moving forwards, the next topic I want to talk about is it actually worth it? Now, it's interesting. It's a really interesting question because for a lot of people, they look at their existing property and obviously there is an emotional attachment to it. So I always say to clients, look, you've got to take your emotional hat off and put your investment hat on when looking to do any sort of transfer or any sort of investment, to be fair, regardless of its, if it's in real estate or equities or commodities or cryptocurrencies or Bitcoin or whatever it may be, it makes no difference. We've got to put our investment hat on. So there's a few things that I would recommend when trying to answer that question, is it worth it? So you've got to look at the property not from a residential standpoint. So in other words, not from the standpoint that you're living in the home, but more from an investment standpoint. So what I mean by that is, we've got to look at the yields, we've got to look at the area, we've got to look at capital appreciation prospects, we've got to look at, is there scope to add value to the property at a later date? And then, if the answers to those questions are yes, 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 this all looks good, then what you need to do also is take it to another level. Take it to the level where you're literally looking at the property and you can see the amount of capital that you have in it, and think to yourself, if I was to redeploy that capital in another property, perhaps in a different geographical location, what would the yields be then? What would the capital appreciation prospects be then? What would the scope to add value be then? Would it be a better long-term investment than the property that you own currently? Now, of course, if the answer to that question is no, there's nothing really out there that beats the property that you own, then we move on to the next stage. The next stage is the break-even point. So this is really important, and it's something that sometimes gets missed. So we've spoken about the stamp duty, and the stamp duty can, on many occasions, actually be cheaper if you transfer your existing property into an SPV and buy a newer property, at a higher price point, then retaining the existing property in your personal name, of course, and paying the additional rate of stamp duty on the new one. But what we need to calculate, though, is what is the cost of transferring the property into an SPV, and at what point in time do we break even? So here's a quick example for you. Let's just say that by moving the property into the SPV, you're going to be saving around £1,000 a month in tax. So if the property is in your personal name, you're paying £1,000 a month extra in tax. If it's in the SPV, you're saving £1,000 a month in tax. So £12,000 over the year. Now, if it's going to cost you £36,000 to move the property from your personal name into the SPV, you're saving £1,000 a month. Your break-even point would be 3 years. And in fact, that's a good number. Most clients are happy with around 7. About 5 to 7 kind of makes sense for them if they're looking to hold the property for the long term. But you've got to drill into those numbers. So you'll need an accountant to do some calculations for you, and you'll need a mortgage consultant to do the rest. But effectively, just to summarize that again, if you've got a property in your personal name and by moving it into an SPV, you're going to be saving £1,000 a month in tax, but it's going to cost you £36,000 for the stamp duty, the transfer fees, the solicitor costs, the broker fees, etc., to move the property from personal name into the SPV limited company. Your break-even point will be 36 months. So here's the bonus that I promised at the beginning of the video. What I would suggest for anyone looking to move an existing property into an SPV limited company, regardless if it's residential or buy-to-let, is think about these questions. Number one, what are the tax implications? Number two, is there a sufficient equity within the property in order for you to carry on with the new transaction? So will the new transaction be successful based upon the amount of equity that you have on the existing property? 3, a market analysis. In other words, compare what you've already got to what you could buy somewhere else, maybe in a different geographical location, and compare the investment prospects of both properties. And then finally, 4, work on those break-even numbers. If all of those things make sense, then I would say go for it. Now, of course, here at SPV Mortgages, we can help you with transferring existing buy-to-lets and residential properties into SPV limited companies. If you've got a broker, hopefully a lot of the information within the video has been super helpful for you, and hopefully that will guide you through this process in a much more smoother way than without watching it. Look, once again, this is my new channel. Please give me the thumbs up, hit the bell icon, subscribe, share it with your friends. I hope you like the content. Please support me. If you do, I'm going to be continuing on this journey. Look, this has been great. I've had a lot of fun creating this video. And look, if you want a little bit of a giggle, I'll add some outtakes, which hopefully will put a smile on your face. See you next time. I'm going to break the video into 5 parts. So the first part is going to be the process. The second, I'm going to talk about limited company mortgages. Third, what is the third part? Don't fucking know. Do that again. Okay, so with your mortgages, not both follow the following.